How do we determine how much a company, how much a business is actually worth? Now, when we buy the shares of a company, how do we know if we are getting it at a discount or if we are actually paying a premium for those shares? The answer to that is valuation. And in this video, we're going to be talking about the discounted cash flow or the DCF valuation model. Now, this is a very popular method of valuation. Basically, we're trying to determine the company's intrinsic or true value based on projections of how much cash, how much money the business can generate in the future. So essentially, we are trying to estimate how much money or how much cash this business can generate over the next 5 years and then further out into forever. And then we take these numbers, these projections of future cash flows, and we convert them into a number that tells us its value today. So this gives us a basis to compare with what the stock is trading for in the market today. The idea here is that if the DCF value is higher than the current market price, then there's a possibility that the market has undervalued this particular stock, this particular company, and maybe it's actually worth more than what it's trading for in the market right now. However, I need to state that this model is not perfect. It's actually very, very subjective. Now, it's impossible to account for every single variable, so we kind of have to make a number of assumptions when choosing the parameters for this model. So because this model is not perfect, it's basically just one of many tools that we can use to try to help us to predict the future. So perhaps don't spend all of your time being so fixated on the results of this model. Just use it as another tool or another guideline that can help in our trading and investing decisions. So in this video, I'm going to talk about a 5-step process of using the discounted cash flow DCF valuation model. I'm going to use an example that I talked about in another video recently, which is Nike. But first, let me emphasize that the intention of this video is just to illustrate how the DCF model works, what information we need to feed into the model, and where can we find that information. This video is not meant to be used as investment advice about the company Nike itself, which I'm just using as an illustration. Alright, so the first step is to determine if the company is a suitable candidate for the discounted cash flow valuation model. Now, the main idea behind using the DCF model is that we are expecting this company to grow and generate more cash in the future. So what we're trying to do is project and predict the growth in that company's business. So in order for us to have such expectations of future growth, minimally, I think the company needs to prove to us that it is capable, that it has a track record of generating such growth. So how can we see that? Well, minimally, there's 3 criteria that this company needs to meet. All the information we're going to be using for our valuation is going to be publicly available information, so you don't have to pay for any information subscriptions or anything like that. So for this example, now we're going to come over to Morningstar and we're going to look for our stock, which is NKE. So we come over to key ratios and full key ratios data. So the first criteria is we need to see increasing revenue. So right here we see that Nike has been increasing its revenue over the past 10 years. The second criteria is increasing net profit. So right over here under net income, we see that the trend of net profit is generally upward for Nike. Now the third criteria is what we are going to be projecting. So what we need to see is that the operating cash flow of Nike also needs to be generally increasing over the past 10 years. And we see that operating cash flow, which is right here, is also in a general upward trend. So for Nike, we see that all the 3 criteria are met. Therefore, Nike is a suitable candidate for a DCF valuation. Alright, so in step 2, we're going to be extracting some financial information and we're going to compile that into a spreadsheet so that we can do our DCF calculation. So I'm going to be doing this step by step so that you can follow along, and then you can also create your own spreadsheet to do DCF calculations. We're going to be using Google Sheets, which is free for anyone to use. The first piece of information to extract is the net cash from operating activities. Now we can find this information back in Morningstar, basically the operating cash flow. So for this example, we're going to be taking the number for 2021. Now we can also find this number in the cash flow statements under financials, cash flow statement, net cash provided by operating activities, 6657 million. So we're going to key that here, 6657. Do bear in mind that these numbers are in millions of US dollars. The second piece of information that we need is basically the cash and cash equivalents. So basically this is the amount of cash that the company has as of its most recent report. So we can find that information in the balance sheet under cash and cash equivalents. So this number here is 9.889 billion. So we can key that into the spreadsheet as well. The third item that we're going to extract is the debt, both the long and short-term debt of the company. Now this information can also be extracted from the balance sheet. So we see that under liabilities, short-term debt and long-term debt. We see that Nike has no long-term debt and the short-term debt is $2 million. So we just key that in here, $2 million. Now why is this debt information important? It's because previously we have seen that Nike has close to $10 billion in cash. The fact that Nike has $10 billion in cash would mean something if it has no debt, which seems to be the situation right here. But the fact that it has $10 billion in cash would mean something else if it also has $10 billion in debt. So therefore, this information is important when trying to assess the value of the company. So the last piece of information we need to extract is the total number of shares of the company that is being traded on the market. So we find that information back in Morningstar under trading information, and we see that the shares outstanding is about 1.6 billion. So we write that here, 1581. So there we have it. This is step 2. This is in the extraction of these pieces of information from the financial statements that we're going to be using in our DCF valuation calculation. In step 3, we're going to be choosing the parameters for our DCF calculation. Now this is where things can get a bit subjective because the parameters chosen can vary according to individual expectations and requirements. So we'll be choosing 3 different rates for our calculation, which are all in percentage terms. The first rate is the 5-year growth rate, which we're going to symbolize with a capital G. Now this number is based on the assumption that this is a good business. Not only would it continue to generate cash in the future, it will do so at a growing rate. Now there are a number of ways to choose this particular growth factor. The easiest way is to use consensus estimates. Basically, this is a number that is determined by analysts who study this stock, and they think that the company will grow by this percentage number over the next number of years. So how do we find this number? We come over to Yahoo Finance, type in the company's ticker, Nike. We go over to analysis, and we scroll down until we find growth estimates. And what we're looking for is for the next 5 years per annum. So for Nike, we see the number is 15.95%. So we're going to key that into our spreadsheet. The second rate that we have to determine is the terminal growth rate. And we're going to symbolize this rate by the small letter G. Now the DCF model assumes that this company is going to exist is going to generate cash and it's going to grow forever. So the terminal value helps us to try to determine at what percentage the company is going to be growing to infinity and beyond. So obviously for the terminal value, we're not going to be using 15% because that might be overly optimistic. Personally, I like to think that this company, being in the industry that it is likely to grow in tandem with the economy, with the GDP. So perhaps for the terminal growth rate, for this example, I will use the annual average growth of US GDP. So we can find that very easily by just looking up on Google. So this website is one of the search results that I got when I Googled average US GDP growth, and it says here that it is around 3.14% since the 1940s. So 3.14% is the value that I'll be using for terminal growth rate. The third rate we need to come up with is the discount rate, which in this example we will call R. Now, because we are looking to project future values here, we kind of have to discount them back to the present value today to take account for factors such as long-term inflation, which over time can cause the value of money to change. So there are many schools of thought when it comes to choosing the appropriate discount rate. And there are no right or wrong answers here. But in the spirit of what we are trying to calculate when we do this particular DCF valuation model, what I would use is what is the minimum amount of return that I want to generate from making this particular investment. So if let's say I want to make an annual return of 5% on this investment, then I will use 5% for the discount rate. Or let's say if I want to beat the average market return, which is about 10.5%, then I would use something like maybe 11% as my discount rate. Or perhaps if I want this investment to beat inflation, maybe I will use the most recent inflation numbers. We saw it was like 6 or 7%. So perhaps I will use 8% as my discount rate. So maybe for this example, let's do that. Let's use 8% as our discount rate. So there we have it. This was step 3. We came up with 3 different rates: the 5-year growth rate, the terminal growth rate, and the discount rate, which we'll be using in our DCF calculation. Alright, so now we've come to step 4, where we'll be executing the DCF calculation. So we're going to use a table to carry out our calculation. So in the first row, we're going to enter the year. Since we're using 2021 numbers as our baseline, the first column will be 2021. And we'll be projecting the cash flows for the next 5 years. So we're going to key in the next 5 years, 24, 2025, 2026. And the last column will be the terminal value. As we have discussed earlier in step 3, terminal value is basically the value of the company, the value of the business, assuming it continues to generate cash at a growing rate forever. In the next row, we're going to assign a numerical value, T, to each of these years, and this number represents each of these time periods. So basically, 2022 is 1 year later, so that's 1, 2, 3, 4, and 5. For the terminal value, we will also be using the number 5. And in the next row is where we begin to do our cash flow projections. Since 2021 is our baseline, we will key in the number for 2021 into this cell. This is the number that we extracted from the cash flow statement earlier. From this point, we're going to be using the 5-year growth rate to project the cash flow figures for the next 5 years. The formula for that is the cash flow from the previous year multiplied by 1 plus the growth rate, which is the big G. So we're going to key in the formulas. So basically this is equals the cash flow from the previous period multiplied by 1 plus the 5-year growth rate, which is this cell right here, C7. And we're going to add in the dollar signs so that as we copy and paste this formula across the other cells, it will basically be referencing this particular cell right here, C7. Okay, so this is the formula. We're gonna copy this and paste it across the next 5 cells. Formula only. Okay, so here we have the projected numbers for the next 5 years. To calculate the terminal value, we're going to be using the Gordon Growth formula. So basically, this is the formula right here, using the 5th year's cash flow projection times 1 plus the terminal growth rate. And then we're going to take this number divided by the difference between the discount factor and the terminal growth rate. This number multiplied by 1 plus the terminal growth rate, and then we divide this by the discount rate minus the growth rate. So that gives us a terminal value of about 296 billion. To make this a little bit more presentable, I'm going to convert these numbers into 2 decimal places. So there we have it. These are our cash flow projections for the next 5 years and the terminal value based on the growth rates that we have selected. In the next row, we're going to begin the process of discounting the cash flows to the present value. So what we need to come up with here is the discounting factor. So the formula for this is basically 1 divided by 1 plus the discount rate to the power of t, with t being the numerical value that we have assigned to each of these years. 1 divided by 1 plus the discount rate to the power of t. And we're going to do the dollar signs to make sure that each of these formulas, when we copy and paste them, will refer to that cell C9. So the discount rate for the first year is 92.6%. We are going to copy and paste this across for all the other years as well. Formula. So now to get the present value of the projected cash flows, we simply need to multiply each of these cash flow numbers for that year with its corresponding discount factor. So we're going to call this row the present value. And the formula basically is this cell multiplied by this cell. And once again, we are going to paste that across. Alright, so the table is now complete. Basically, we have projected the cash flow generation of the company over the next 5 years and its terminal value, assuming it continues to generate cash flows at an increasing rate forever. And now we have multiplied each of these by its discounting factor to get its value today. The total value of the discounted cash flows, basically we are just going to add up all the figures in this row, and we get a number that is close to $243 billion. So now we're going to make some adjustments to this number to account for the present financial situation of the company. So what we're going to do is we're going to add the cash and the cash equivalents. So that is basically this number that we have extracted earlier. And at the same time, we are going to deduct the debt of the company. So that is equivalent to negative of this number that we extracted earlier. So this gives us the value of this company based on this DCF valuation and the parameters that we have chosen. We get a value that is close to $253 billion. So this number here is the value of the entire company. The last thing we need to do here is to determine what is the DCF value for each share of the company. So this is the DCF value of shares. And what we're going to do is we're going to take this number that we have calculated divided by the total number of shares. And what we get is a DCF value of around $160 per share of Nike. Alright, so there we have it. Basically in step 4, we have completed the calculation of the discounted cash flow valuation model for Nike based on these parameters that we have chosen. In step 5, what we're going to do now is we're going to compare this with the current share price of Nike. So based on the selected parameters, we see that the DCF value of Nike is around $160 per share. As of yesterday's market session, we see that Nike was closed at around $136.83. So let's just take this number and put it into right here. So the shares were trading at $136.83, which is equivalent to a 14% discount. So the market may potentially be undervaluing the shares of Nike by about 14%. So what do we do here? Do we just buy the shares straight away? Well, what we do with this information, what decisions we make, it really depends on a number of other factors as well. All this model gives us is a possible indication of how much the company may intrinsically be worth. And we can use that information along with other factors to make a decision about whether we're going to buy this share or whether we're going to sell it or whether we're going to sit on the sides and observe it. Remember, the DCF valuation model is a very useful tool that can help us, but it should not be functioning as a crystal ball. So there we have it. This is how we calculate valuation using the discounted cash flow DCF valuation model. Now this model can give us an idea of how much a company is intrinsically worth, and then we can use that information to help us in our trading or investing decisions. However, DCF also has its limitations. As we have seen, there were a number of assumptions that we had to make. For example, the assumption we made that the company's cash flow is going to continue growing, and in fact, it's going to be growing forever. Now, that can be quite a stretch because things are changing all the time, and we can never really know what the future holds. Secondly, the model is actually quite sensitive to the parameters that we choose in step 2. The growth rates and discount rates that we choose can vastly affect the results that we get from using the model. So once again, this model is not perfect, and we should not be using it solely to make our trading and investment decisions. Alright, so that's it for today's video. I hope it was helpful for you. I do hope that you have learned something today about a tool that you can use to help you in your trading and investing decisions. So do leave a like, comment, or subscribe if you did find it to be helpful, and I will see you in the next video.